Option Alpha, how to achieve alpha with options trading. David Jaffe from BestStockStrategy.com, and before we start, I want to make it abundantly clear that whether you choose to learn from me, Option Alpha, or TastyTrade, selling option premium is the only way that you can earn consistent and predictable money in the stock market. And even though I'm not a fan of Kirk Du Plessis, I think that he's not a profitable trader, and I think that his students do not make money. I also think that learning from Kirk is way better than learning from, as long as you're selling option premium, that's fine, because if you're trying to day trade or use technical analysis or trade Forex, you're not actually a trader, you are a fraud victim. So in this video, we are going to discuss how you can achieve alpha. And one of my biggest criticisms of Kirk Du Plessis from Option Alpha is I don't agree with the trade often principle. What Kirk does is he trades iron flies on ETFs. And I don't like trading ETFs because they receive about half as much premium as the underlying securities. So for example, why trade an iron fly on SPY when instead you could trade a put or a call on Apple or Facebook? Additionally, when you're putting on an iron fly position or even a straddle position, you are inherently putting on a position at an inopportune time. An example of a trade that we made this past week with my alert subscribers, where we put on a strangle at an opportune time, Amazon fell to about $16.50. I then instructed my alert subscribers to sell a $14.80 put. Those people who wanted to turn that trade into a vertical, they could sell the $14.80 put and buy like a $13.00 put. The next day, Amazon increased in price by around $120. I then told my alert subscribers to close out the previous trade. But for those people who didn't close out that trade, I also told them that this was an opportunistic time and an opportune time to sell an 1860 call. So for those people who did not close out the trade, they will be short a 1480 put, and then they would also be short an 1860 call. They received a tremendous amount of premium from that position because they sold the call after Amazon increased in price by about 5%. If they sold that call when Amazon was trading at $16.50, instead of receiving around $5, they would have received around $1, in which case it would not have even been worthwhile to enter that trade. So that's my problem when you sell strangles, in that you're inherently not maximizing the amount of premium that you receive. And in a down market, you should definitely sell calls. Like over the past month, we have sold a lot of calls, because that's how you make money when the market is extremely volatile and the market is going down. But at the same time, I do not agree with indiscriminately selling strangles, and I definitely don't agree with indiscriminately selling straddles, and I 100% don't agree with indiscriminately selling iron flies on ETFs that have high implied volatility, because that is a situation that's going to be incredibly stressful. You're going to have to manage the position. You're always going to have to log into your account 5 or 6 times a day to make sure that that position is not exceeding either the upper or the lower bounds, that it's not showing you a loss, etc. There's no safety net when you sell a straddle. Zero. So even though I understand like all the logistics behind it, even if it's profitable, right? Like even if you sell a straddle and then you immediately enter a limit closing order to take off that trade at 25% of the profits, you're still going to have to log into your account multiple times a day to make sure that you're not showing a massive loss. And especially with the volatility that we've seen in the marketplace over the past 2 or 3 months, where a 1 or 2 or 3 standard deviation move is not uncommon, as it has been over the past few months, you are really going to have to log into your account multiple times, make too many adjustments, and you're going to feel like a pinball, because the stock on the upper end is show you a large loss, and on the lower end it's going to show you a big loss. You're going to make adjustments only to find out later on that you should not have even touched that stock at all. The point that I'm making is that selling iron flies on ETFs or even iron flies on regular large cap securities is not a smart way to make money, because you're going to have to constantly deal with the stress. You're going to have to manage your position and deal with multiple adjustments, and especially in this situation where volatility is very high and 1 or 2 or 3 standard deviation moves are becoming relatively commonplace, that is not a good strategy at all. When you sell puts or calls on positions that are too far extended, you are giving yourself a tremendous advantage because you have a tremendous safety net. A good example, right? So Facebook last week, I believe in like the early part of the week, it was traded up to around 152, right? Like it exceeded their earnings and then traded up to around 152, 153. We waited until Facebook fell down to 1460 until we sold the 135 put. Now that gave us an incremental $6 of cushion, the difference between 152 and 146. And because the volatility of Facebook was increased from when it was trading at 152 to 146, we received around twice as much premium as we would have received had we sold the 135 put when Facebook was trading at 152. Again, remember, you need to mitigate risk and build in the most safety net that you possibly have. And that's why in that Amazon trade that I gave you as an example before, we waited until Amazon fell to 1650, then we sold the 1480 put. Then, since we have no idea what future price movements are going to do, we waited until Amazon was up around $100, and then we sold the 1860 call, because that was an incredible opportunity. If Amazon, one of the largest companies in the world, is up 5% in a day, we don't think that the probability is high that the next day it's going to also increase by 5%. So we took advantage of the fact that at that moment we believed that Amazon was too far extended on the upside. So we had a built-in, we had a very large safety net. We still gave ourselves over $100 where Amazon could still go up over $100. And we also, once that trade executed, we entered in a position to close at 50% of the maximum profit. And we actually closed out that trade 2 days later for around a 50% gain. That's how you trade, you minimize risk, and you are opportunistic while at the same time building in a substantial safety net. All right, like I said before, I don't believe that Kirk Du Plessis' desire to trade solely based on high IV, and you're not basing it on market conditions, and it's an inopportune time for you to enter trades. You believe that it's an opportune time solely because there's high IV, but at the same time, some securities are way better than others. Like over the past 3 months, Amazon has actually been a lot more stable to trade than Facebook, because Facebook was trading at around $218 and it fell all the way down to around $140. Amazon would trade at around $2,000 and it fell all the way, actually I think 2 weeks ago it fell down to around $1,500, but that was relatively temporary. It's the majority of Amazon's trading range has been between around $1,700 and $2,000, generally within like the $1,700 and $1,900 range. You can make a lot more money when the stock is less volatile like Amazon than you can when a stock is extremely volatile like Facebook. But the point that I'm making is that you have to look at the trading range of the individual security and then discern what is an A+ opportunity relative to like a B or a C opportunity. Because when the market goes down, everything has high implied volatility. The VIX is very high. The VIX right now is around 18. Last week it was around $22, right? 22 to 22. That's extremely high. That means that anytime you sell option premium, you're going to collect a lot of money. But all of the opportunities are not the same. So you have to discern, and because it's your money, you have to discern what's an A+ opportunity versus a B opportunity or even a C opportunity. And I can tell you from personal experience that the times that I've made the worst trades, it's always been with the B or the C trades, like those type of securities, like the Baidu or the EA Sports, the Electronic Arts. Like I rarely ever lose money with Facebook or Amazon, rarely ever. Maybe like 1 out of 30 trades on Facebook or Amazon are not profitable, or 1 out of 30. I've never lost money on Lockheed Martin. I've made hundreds of thousands of dollars on Lockheed Martin. I've made over 100,000 on Raytheon. I've never lost money on those securities. But the Electronic Arts, the Baidu, those are the securities which are like the B or the C players that I have lost money on. The other thing is, I do think in general, even right now, where it's like mid-November of 2018, where there's been a lot of volatility, I still think that your goal should be to sell puts on large cap market leading stocks that are on the low end of their range, and then as they increase in price, you would then sell a call. Great example of this, right? So all right, great example would be Amazon. But I do not at this moment proactively sell calls on many securities. Maybe I did do that on McDonald's because McDonald's right now is around like 185 and it's gone up consistently. So this past week I sold a 195 call on McDonald's, but it's extremely rare for all intents and purposes, even in this market, unless the market declines consistently so that I know that we're in a bear market. I'm still in the mindset where I'm going to wait for the Facebook, Amazon, Boeing, Lockheed Martin, Raytheon to fall on the low end of its range, and then I'm going to sell a put that's around 10 or 15% below the current trading price. Then I'm going to wait to see if the stock price appreciates, just like Amazon when it went up like $120, around 5%. And then at that time, and only at that time, am I going to be opportunistic and sell a call on that specific security to turn that into a strangle. It is extremely rare that I proactively search to sell a naked call or a vertical call on a stock that I don't already have a put position on. So if I'm going to sell a call, it's extremely rare that I don't already have an existing put position on that. And the reason is that it's much more capital efficient for you to sell a put and then also sell a call because it doesn't use up any incremental buying power. So for example, when you sell a put on Amazon when it's trading at around $16.50, if we sold the $14.80 put and then I waited for Amazon to go up to around $17.50 and then I sold the $18.60 call, by me selling that $18.60 call, I'm actually not using up any incremental buying power if I put the position, if I match up the expiration. So the expirations on the $18.60 call and the $14.80 put were the same. As a result, there is no incremental buying power that's being used by me selling that $18.60 call, because remember that Amazon cannot be trading over $18.60 and below $14.80 at the same time. So as long as I match up the same number of contracts and the expiration, then I'm essentially collecting premium without using any additional buying power. So like I said, option alpha, how to achieve alpha with options trading. I do not ever recommend trading iron flies on ETFs. Recently, over the past month or two, I have been trading more verticals, mostly to protect myself against the heightened volatility. I'm still not a huge fan of selling verticals because I do recognize that when the market is increasingly volatile, you can turn any naked position into a vertical credit spread. And also at the same time, when you trade vertical credit spreads, it's incredibly difficult for you to manage that position. I mean, you effectively can't roll that position. Instead, the only thing that you can do is really close it out. Now, I know that that's not 100% true. You can roll that position, but it's incredibly expensive. And instead of allocating some of that money towards reducing or having a more favorable strike price or even reducing the size, you're instead going to use that money that you would have used to reduce the size or have a more favorable strike price in order to buy an overpriced put option. So what I sometimes will do, like I did around 3 weeks ago in the middle of October, is I did buy some puts just for portfolio insurance because the market was going crazy and October 2018 was the worst month in around 7 years. But I'm still not a fan of using vertical credit spreads, although lately I have been using them a lot more. But I'm not a fan of trading iron flies on ETFs. I think that you should definitely be more opportunistic and build yourself in a wider moat and a much better safety net, which is the way that I trade. My strategy is much more opportunistic. You build yourself a much greater safety net, and that's why my returns are substantially higher. In 2017, I made around 72%. I don't think that Kirk makes much money, but at the same time, I also don't think that he loses money. I just don't think that he's a profitable trader. Maybe he breaks even, maybe he loses 1 or 2%, maybe he makes 1 or 2 or 5%, but I don't think that he makes that much money, and I think that a lot of his students lose money because they're going to be pinballed back and forth, and they're constantly going to have to make adjustments only to find out later on that the adjustments that they made because they had an overreaction to one specific day, and then they're going to see that a day later that stock pulled back. Like a great example is if you sold an iron fly on Amazon, you would have been shitting yourself literally because Amazon increased in price by 5%. But at that time, we used it as an opportunity to make money because we were patient. We had a very wide safety net. We sold the put. when Amazon fell down to the relative low of its trading range at 16.50, and then we sold a 14.80 put, and then we waited for Amazon to go up. It just so happened that it was the next day, and it went up around $120, and then we were opportunistic, and we collected a lot of premium by selling that 1860 call, and then 2 days later, we closed out the 1860 call for a 50% profit. So by by indiscriminately selling iron flies, you are not maximizing your probability of profit. You're also not giving yourself any type of safety net, and inherently you are giving yourself a much higher probability of giving into temptation to manage positions way too early, only to then realize days later that you should not have touched that position at all. This is David Jaffe with BestStockStrategy.com. Remember that straddles do not provide you with any safety net. Even if you close out that same position, that straddle at 25% maximum profit, straddles do not give you any safety net. You can go to BestStockStrategy.com and receive $400 of free training, which is better than anyone else's paid materials. Just go to BestStockStrategy.com and enter in your email address. If you have any questions, let me know. But I also want to reiterate that I'm not anti-option alpha. Just like I do think that TastyTrade is much better than option alpha. I think it's an inherently far superior resource to option alpha, but I'm not anti-option alpha. Like, I definitely think that all of us are saying the same thing, that you have to sell option premium. And I do think that, like, Tim Sykes, Ricky Gutierrez, but Kirk Du Plessis from Option Alpha, he's definitely not a criminal. I just don't agree with the strategy. So if you have any questions, let me know. I'm here to help you, and thank you for watching.